So your truth bomb for today is this. The Fed doesn't have to burn down the house to put out the fire. But if it keeps pressing above neutral, it just might. The danger now is the Fed's confidence in its own control. Policymakers are looking at backward-looking data and convincing themselves that the economy can handle higher real rates indefinitely. But slowdowns always look mild before they turn ugly. In 2000 through 2007 and 2018, the data looked fine until it really wasn't. The Fed has a habit of reacting after the turn, not before. That's why the current policy path feels like playing with fire. The economy is showing clear signs of fatigue. Real rates are deeply restrictive by any reasonable estimate of R star. The Fed still, though, talks tough about returning to 2% inflation on schedule. And the market, along with households, is far more sensitive to policy than ever. We've read the script before, and it doesn't end with a gentle glide. It ends with layoffs, contraction, and Fed cutting much faster than it ever imagined. This doesn't mean the Fed should give up on its mandate, but it does mean it must recognize the asymmetry of risk. If inflation edges from 2 to 2.5% or 2.7% for a few months, that's not a crisis. If unemployment spikes, it is a crisis. Household pain is not an abstract concept. It's a thing that defines a recession. And recessions are exactly what happens when policy stays too restrictive for too long. So yes, prices are still too high, and inflation remains the headache of the day. But if the Fed wants to avoid burning down the house, it needs to think very carefully about its next move. The last time policy sat above neutral for any length of time, in 2018, the economy stumbled. Today, the Fed is far above neutral, and the warning lights are already flashing. So your truth bomb for today is this. The Fed doesn't have to burn down the house to put out the fire. But if it keeps pressing above neutral, it just might.